This is Money Talk on News Talk 580 CFRA. Here is John Budden.
Good afternoon, folks, and welcome to Money Talk. Here's the lineup for today's show. We start with Dave Sally of the Ottawa Business Journal, then go to Kevin O'Leary, chairman of the O'Leary Financial Group, and on to David Prince, founder of Harbinger Capital Market Research. After the news, my interview with Robert Lloyd George, Chief Investment Officer at Lloyd George Advisory in Hong Kong. And to conclude today's show, I talk with my old friend Dean LeBaron, a venture capitalist and founder of Battery Marsh Financial Management. And now to Dave Sally of the Ottawa Business Journal. Well, it's that time again. I'm joined by Dave Sally of the Ottawa Business Journal. How are you, Dave?
I'm great, John. How are you?
I'm okay, and you're heading off on holidays, so we're not going to be able to talk to you next Sunday, but you'll be back the following Sunday.
That's right.
Well, let's get to the business of Ottawa. Dave, this past week, an Eastern Ontario mobile technology company announced it was opening a new Ottawa office, while microwave networking firm DragonWave announced another quarterly net loss. Meanwhile, there is some positive news on the local real estate front.
That's right, John. Well, let's start with Eastern Ontario tech firm Pycom's plan to open a new office in Ottawa. The company develops mobile technology products for enterprise firms and is headquartered in Plantagenet, about an hour east of Ottawa. It says the new office, which will be its third, will allow the company to expand its workforce by 40% and give it easier access to Ottawa's larger talent pool. Now, it's been a pretty good year for Pycom. In September, it made the Profit 500 list of the fastest-growing companies in Canada after reporting revenue growth of more than 200% during the previous 12 months. This will be the second new office for Pycom in less than a year. In May 2015, the company moved its headquarters from Alfred to nearby Plantagenet. And the company says it will maintain its offices in both Alfred and Plantagenet, in addition to the new office in Ottawa.
Well, meanwhile, the news wasn't so good this week for Ottawa-based DragonWave.
No, John, that's right. DragonWave reported its 23rd consecutive quarter of net losses this past week. The company, which sells microwave networking equipment to wireless companies, recorded revenue of $12.5 million for the three-month period that ended May 31st. Now, that was down from $23.6 million during the same period a year earlier. On the plus side, though, the revenues were actually up almost double from $12 million in the previous quarter. Still, that put DragonWave's net loss for the first quarter of fiscal 2017 at $4.1 million. Now, that is down from a net loss of $5.95 million, which it posted during the same period a year earlier. And the company said that was largely due to a decline in the cost of sales and an increase in gross margin. DragonWave says it has now reduced its break-even point to $21 million in revenue. And during a conference call with investors this past week, company executives did not give a timeline for DragonWave's return to profitability, which was something they have done in the past.
And finally, some positive news on the Ottawa real estate front.
That's right, John. The city's real estate market is among the most stable in the whole country. That's according to the latest market study from Colliers International, released this past week. The company says Ottawa's cap rates, that is the ratio of a property's operating income to its value, have remained largely unchanged in almost every sector. Colliers says downtown vacancy rates have increased over the past 18 months and now sit at about 10.8%, which is driving down rents in the downtown core. But the company says that with the new Liberal government now in power in Parliament Hill, vacancy rate will probably start to come down and rental rates will rise, which is good news for landlords. Colliers also expects the commercial market to become more competitive for landlords. It says both the federal government and private businesses are seeking out buildings with things such as LEED certification, as well as more attractive locations. Now, on the industrial side, short supply is driving rents up, Colliers says, making Ottawa one of the best markets for industrial landlords in the country. Colliers says the average industrial asking rental rate in Ottawa is $9.96 per square foot, compared with just $5.37 in Toronto. However, there is a downside to that. Colliers says those high prices are pushing tenants to look to Toronto or Montreal for more competitive rents. Meanwhile, in the residential market, purpose-built rental buildings are being constructed for the first time in Ottawa in about 20 years, Colliers says. That's due mainly to a slowdown in condominium development, as right now supply is outpacing demand. And Colliers says it expects this trend to continue for the foreseeable future.
And Dave, what is on the OBJ radar for this week?
Well, John, most entrepreneurs will tell you having a strong business plan is a major key to success. So if you want to learn how to go about devising a great business plan, check out Invest Ottawa's seminar on Wednesday, July 20th. That's at 12:30 p.m. at Invest Ottawa headquarters at 80 Aberdeen Street. And for more information, check out investottawa.ca/events.
Well, that's great recap of the week's activities, and I want to wish you a good holiday. You deserve it, and we'll look forward to talking to you not next Sunday, but the following Sunday.
All right, John. Well, thanks a lot. I hope to come back rested and relaxed and ready to go.
Now to Kevin O'Leary, who is chairman of the O'Leary Financial Group.
Let's get back to our top line. Stocks today struggling for a bit of direction, a little bit of a stumble. This is after a record-breaking winning streak on Wall Street. For a closer look at what's driving the markets and if now is the time to maybe get out, joining us now from Muskoka, Kevin O'Leary, chairman of O'Leary Financial. Kevin, how are you?
Great to be here. Thank you.
All right. So this rally this week, we've been asking a lot of fund managers, do you believe in it? We reclaimed the losses of Brexit, hit all-time highs. What are the fundamentals, and can we continue to see gains?
The fundamentals are there's no other way to put money if you're hunting for yield except stocks with dividends, and that's what's really reflected this rally. With the exception of financial institutions who can't make money anymore with incredibly low interest rates, every other sector that returns capital to shareholders has reached new highs because there's really no other place to deploy capital. And so what's interesting about this rally, and every rally and every new high is different than the one that preceded it, is that for the first time ever that I can recall, I have never seen more cash on the sidelines for institutions than now. What's basically happened is all the allocations for fixed income instruments have not been deployed. So let's say you're running a pension plan or a sovereign fund and you're 30, 40, or 50% fixed income. That's all sitting in cash. So you've got this remarkable situation where never before has there been so much cash, and yet the Dow and the S&P have hit new highs. It's a remarkable situation. You can look at it either very, very conservatively, saying that the low interest rates and low bond yields are a sign of warning and risk ahead, or you can say this rally will continue to increase because that cash on the sidelines will eventually be put into equities. I tend to be more optimistic. I think this is very sustainable, even though there's tremendous risk globally, politically, terrorism, obviously. The market rallies on because there's nowhere else to deploy cash for returns than equities.
Now, the big institutions, Kevin, this is what we often refer to as the smart money. If they're in cash to this degree, should the retail investors watching us right now take a page from their book?
Well, what's interesting is they don't look so smart. Their returns have been muted by the fact they've kept so much cash on the sidelines. Nobody believes this rally, which is why it just keeps rallying on. A great rally is full of skeptics. It's full of a wall of worry. It's full of people that don't believe it and eventually capitulate and buy to the upside. And you get this burst towards the end, which really actually does signal the end of the rally. We're not there yet. We haven't had the capitulation to the upside yet. And yet, almost 5 days in a row, in some of the most remarkably complex political and, this thing in Nice is horrible, but it didn't deter the market much, which is incredible.
Now, Kevin, I know you have strong opinions about the housing market in Canada. We got numbers again today telling us what we really already know. Toronto, Vancouver, soaring there. Interesting. Bank of Montreal this morning had a little graphic, and it basically showed the growth of borrowing of consumer debt in this country. It's up about 6%, respectable. There's some strength there, but prices are soaring. They say there's a disconnect. The money has to be coming from somewhere else. In your gut, where is this money coming from? What does it tell you?
No, I think banks would like to have you think it's not coming from them because they're getting a lot of political pressure from Ottawa and the provinces to curtail their mortgage lending. It's an area of profitability, not from the profits of the mortgage, but once you open a mortgage account with a Canadian bank, they sell you all kinds of other services, credit cards, personal accounts, and they charge fees. So it's a form of like selling milk in a grocery store. You want to sell milk. It's a loss leader. the milk of the financial services industry are housing mortgages. So banks are doing everything they can to keep it going, regardless of what they say. Sorry to be a skeptic, but I'm telling you the truth. Rates are at historic lows. Money is free. Although I will tip my hat to Canadian banks in this sense. They're not being foolish about who they lend to. If you try and borrow a tremendous amount of money to speculate in the condo market in Toronto or Vancouver or Montreal, which has actually gotten speculative of late, they won't lend it to you. They want to know that you've got skin in the game, at least 20% equity. So I don't think they're being irresponsible. But what I like about what's happening, which I think is going to be part of the next election, is housing prices have become political at the provincial level and at the federal level. You've got basically politicians jawboning the market, which of course never works. But for a politician, the only tool they can ever think of to help the situation is to suggest taxing it. And so you've heard the provincial government say, let's tax foreign investment in Canada, in housing, and the Fed saying, let's tax it. The poor guys don't know what else to do. Of course, that would be a disaster because the number one asset
do you think
Canadians
we'll scare
have...
away foreign investment? On all levels, if we start taxing it in one sector?
Well, of course, they'll just invest somewhere else. We'd have to be idiots to do this. But what it will really do is cause a correction in housing, which would be very detrimental to the party in power. Whether you're sitting as the NDP in Alberta or you're the Liberals in Ontario, if you take down the number one asset of a Canadian family, it's political suicide. Now, as a card-carrying registered conservative, I hope it happens to them, but I don't want to see that occur because, like everybody else, I own real estate. But politicians do very stupid things sometimes, and if they mess with this market, they deserve what will happen to them. They'll be history.
All right, let's talk politics, but south of the border. Republican convention next week. Who's the best candidate as far as the Republicans go for the United States of America?
Well, obviously, it's the Trump, and now that he's named his vice president, there's been an amazing amount of activity this afternoon in terms of how people feel about this uniting the Republican Party. This is going to be really interesting. I saw the poll results after the announcement because there's all kinds of flash polls going on, which are only a few hours old. Trump and Hillary Clinton are now neck and neck. They are even in 8 states that really matter for this election. And so what I think is going to happen at this convention next week is you're going to see a lot of moderation, I believe, in what Trump's going to say around 2 critical political platforms. 1, immigration. My guess is he'll soften that. Number 2, trade arrangements. What I'm hearing from party insiders, and I just spoke with one about 20 minutes ago, is that the new theme will be, instead of changing and tearing up trade agreements, Trump is going to enforce existing policy. In other words, there's been a lot of lax enforcement around NAFTA. He's going to tighten that up. That way he can balance between the hardcore right-wingers that want to see those agreements torn up and those that believe that free trade is still beneficial to the U.S. He'll go down the middle of the road saying, let's just enforce the rules already in place. Now, of course, this is all speculative, but it would be a shrewd move on his part because he would get to unite a party that's really fractionist right now in the Republicans and get ready for an onslaught of debate going on with Hillary Clinton. And by the way, all kinds of social media, I don't know if you've seen some of what's come up in the last few hours, the Republicans have launched a Pokemon social media Hillary Clinton attack ad, which is absolutely hilarious. And I think we're going to see a lot more of this really innovative political satire, which I think is very healthy in the debate.
Got to get on the trend. All right, thanks for that, Kevin.
Take care.
BNN contributor Kevin O'Leary.
Okay, folks, we're going to a break, and when we come back, David Prince, founder of Harbinger Capital Markets Research. You are listening to 580 CFRA.
You're listening to Money Talk on News Talk 580 CFRA.
The Dow and the S&P 500 reached all-time highs this week. Investors shook off the Brexit blues and they had some renewed optimism about the U.S. economy. But are we a little too optimistic? For perspective on this, noted market bull, Harbinger's David Prince joins us. Good to have you with us.
Nice to be here.
I want to get into that particularly, but we're sort of seeing some developing news over the course of the last 20 minutes or so out of Turkey. And it looks like we've got a military coup. I'm getting conflicting reports here that the armed forces have taken control of the country, but the government says no, they have not. As an investor, what do we do with this information?
Well, I think the investment world has had a pretty clear idea what to do, and that is get my money out of that area because no one knows. I mean, obviously this week, that tragedy yesterday with the bus incident, there is no doubt that if people think that this whole area has settled and, it's post-Brexit, therefore everything should be wonderful and rosy again, that's not the case. Obviously, this thing is not about to end. We've heard lots of rumblings from the intended candidates for the U.S. presidency. That's going to be interesting because it's a different approach. I mean, basically, as we all know, Obama has decided to ignore ISIL until this last month because it doesn't exist and hadn't existed, and it's not an organized terrorist group. But that said, it doesn't matter whether it is or not. We've got lots of these disruptions that are going to continue, I think, to happen. Especially with the disparity that we're seeing. I mean, the fact that Hollande, the great socialist, pays his barber $14,000 a month is a pretty interesting side to it. But that said, there's lots of anger in Europe that's not about to dissipate, no matter which way we look at it. And until that economic improvement really starts to show and filter down, expect more of it. And I think the world of investment, to answer your question directly, is better suited to be away from it.
Well, we weren't this week with the Dow hitting yet another all-time high today. We had the S&P 500 break a 4 all-time high winning streak. But you and I have discussed this in the past, that if you don't see the transport sector join a bull rally, it's a false bull rally.
Well, it certainly this week we had lots of participation by the transportations. But I think the better way to put it in perspective is to see how far the transports are below their high versus what the index for the industrial. And keep in mind that the industrial's had so many changes to its mix that it's unbelievable over this last several years. So the point being that we do have some big weighted stocks, and it doesn't take much. One of them, when you look at the Apple, of course, of this world, but that's down relative, but it's a big weight. But you do get this big movement in the international stocks. And what I really want to emphasize here is that all of the stuff that we just talked about when it relates to Europe has only prompted more investment into the United States. We've got the big fear of missing. We've got this low rate mentality is going to persist forever. This sounds too cute because it's all managed by central banks, but let's recall the last time that we had this great lift and it ended in a bad way, and that was back in 98. So we had this wonderful period from 98 until 2000 where everybody couldn't figure out why the market was being valued like it was. That was the time that we had the Greenspan put, that every time the market would go down, of course, Mr. Greenspan would say, I'm going to inject more liquidity, I'm going to lower rates. That type of false confidence is now seemingly permeated everywhere. And it doesn't matter whether it's Japan's Abbey or whether we're going to get more of Mario's playmaking. The point being that the central bankers of the world believe that constantly throwing liquidity into this will solve all the problems.
But we know that there's a law of diminishing returns. We saw that with QE1, 2, 3.
And that's the point that I really want to address because we're at that stage. And to see that we've put in this several trillions of dollars, I've talked about it in the past, and see such a feeble recovery, and that's really what you've got, given the amount of injection. I don't know what black hole it's going into, but you sort of wonder, you take a look at budget deficits globally and they keep expanding and you wonder when it's ever going to stop. But my message here in terms of looking at companies, there's two things to remember as we go through earnings seasons. Be very careful, one, of how much share buybacks there has been with that company.
Because that's a false profit growth.
Absolutely. And make sure you address the fact that they've had a revenue growth that is commensurate with that earnings growth. That's not clear at this point. We've had mixed reaction to the overall reports. We're early. Let's watch the rest of them.
So as we look at all-time highs for the S&P 500, you've been looking at the S&P retailers versus the defense and aerospace group?
Well, what I wanted to do is to show you groups that kind of surprise in terms of what's happened to them on an index basis. If you recall in the first quarter, the group that was really hit dramatically was the retailers, especially name brand retailers in the United States. We talked about closures of the old brick and mortar. And what's happening, if you look at the retail index, it's blown through a massive new high. Things are supposed to be rosy. We got a good retail report, which is more than suspect today. But that said, the headline, everything looks good. Then you start to tear it apart, and then you realize that within that retail mix, which is that yellow line that you're seeing that's been soaring all the way through, is the fact that there's a big thing called Amazon, and that's been the big driver throughout that. There's lots of the retail that are still down and ugly, but we have seen a recovery in a number of those retail stocks because they pay a healthy dividend in a lot of cases. The one at the bottom, though, is most interesting. Here you have anti-war president, very much against defense spending, etc. One of the best performing groups in the overall sector since his presidency has been aerospace and, of course, the defense spenders. Now we're seeing them just break out. This is where the long-term belief that the American dollar was going to push some of these things out of business, that's not the case. You're seeing companies that GE are already diversified, and that's what's driving that index.
Okay, you touch on that U.S. consumer component to it, because yes, the retail sales report did come out strong, but that's a backward-looking view of the American consumer. The University of Michigan consumer sentiment came in well below expectations and below where it previously was.
Yeah, I would like to talk about that, because that tells you that what you're dealing with is the consumer spent a lot in the June period. What did he spend a lot on? Cars. What did he do? I was blown away. I saw the numbers today. The average monthly payment now in the United States has been boosted on these cars to almost $500 a month. That's average. So think what people are doing. And it makes more sense. If you're buying a higher-end car, you're not going to throw your cash down. You might as well get the cheap deals from the auto companies.
But then you get the export report from Canada, and it shows that auto exports were really down. So another second indicator that says the future isn't as bright as we first thought.
The railroads are telling you that the July is going to be very weak.
After the news, my interview with Robert Lloyd George, who is the Chief Investment Officer of Lloyd George Advisory in Hong Kong. Stay with us, folks. This is 580 CFRA.
Now back to Money Talk on News Talk 580 CFRA.
It's great to be joined by Robert Lloyd George, who is the founder and Chief Investment Officer of Lloyd George Advisory in Hong Kong. And we have a regular monthly chat, and we've got a lot to talk about this month. How are you, Robert?
I'm well. It's always a pleasure to catch up with you, John, and have a calm discussion about the volatile events in world markets.
We have had the Brexit vote, and I guess that's where I'd like to start to get your comment on the aftermath. We've seen political changes, and it looks like we're in for a 2-year divorce.
Yes, I mean, it is a historical watershed. There's no question about that, John. I mean, we didn't anticipate it any more than any other pundits did. Very few people saw it coming, even though the polls were close. We did, however, have quite a lot of cash and some gold in our funds, so we've been up 5% over the 2-week period and got reinvested afterwards. I don't think there's such a big impact on Asia in our special situation. But let's think about Europe and the world. I think it's an important signal that the British people are saying we've had enough of uncontrolled immigration. We don't see the benefits of free trade. And that, to me, is a big change. And I think Donald Trump is signaling the same popular mood, which is, okay, free trade might sound like a great idea, and it has been for the world for 30 years. But at this stage, we, the working class, middle class people, have no stake in it, have no interest and benefit from it. And I think that any government now has to take account of that. So I think that whether or not Trump gets elected, we're likely to see some more protectionist policy. And that is a major change in the international investment scene.
Now, taking a look at the markets post-Brexit, well, let's start with the Chinese market, because it seems to be auguring QE for not just the Chinese market, but certainly markets around the world.
Yeah. It's interesting because today the Bank of England decided not to cut rates, and everyone thought they would, and that they would flood the system with liquidity to counter the shock or the economic downturn which is expected to come from Brexit. Maybe it won't be as bad as all that, but I do think that there is a tendency, especially in Japan, which we're watching very carefully at the moment, to venture out further, possibly into the territory of helicopter money. We've had steep negative interest rates in Japan. I think they're almost minus 1%. So they're the most extreme case in the laboratory, and it hasn't worked at all well. The yen has strengthened. Their business situation has not improved. And I think we are really nearly at the end of these central bank maneuvers. So I would say in Europe, too, they've got to bail out the Italian banks, which is a very big deal indeed, in some ways bigger than Brexit in financial terms. And so how much further can these central banks go? Yes, everybody's now saying the Federal Reserve won't increase rates this year, so that means off to the races for the Dow Jones and indeed for the emerging markets. But I feel cautious because I don't think commodities will rebound. I don't think world trade is growing. And I think this protectionist policy down the road, 6 months, 9 months, will eventually catch up with investor expectations.
Money can't get a return in fixed income, and so investors seem to be crowding into equity markets in search of yield.
Right.
And you just have to wonder how long those shares can justify the prices. If you get any dividend cuts or a slowdown, you've got an equity market that is very full.
Yeah, and then you have to ask the question, which sectors do you want to invest in? And clearly the utilities and telecoms, consumer staples, even tobacco and things like that have done very well. And I think they will continue to do well as long as we have a deflationary environment where they can sustain prices for their services and goods. And in general, the consumer is hurting. So luxury goods will hurt, but consumer staples will do well. And we see the same thing in Asia, and the internet companies are doing well because they're helping consumers get a better deal, whether they're going on overseas trips or they're buying clothing or electronic machinery. They get cheaper prices from the internet. So there is there is growth in the Asian equivalents of Amazon and Google.
Now, could you tell us about? Can you hear me, by the way?
Yes.
Yeah. Could you tell us about your allocation to the various Asian markets, and of course the high point being the Indian market?
Right. As I say, in early June, I was pretty defensive. I had 25% cash. I'd increased our exposure in Australia, where we had a couple of smaller gold mines, Evolution and Newcrest. We've got a very good healthcare company there. We had about 15% in China and a little bit less in Hong Kong. We've cut those allocations now. I'm still cautious about the direction of China's economy, except in special situations, which are travel, education, and internet. And we have put our cash to work since June 25th in India principally, which is now rising to 20-25% of our bamboo strategy. In Indonesia, which we have raised to 5% and eventually 10%, Japan is around 10%, and we've added also in Korea to about 10%. So we are diversifying quite widely, but our biggest allocation is India. And I think the reasons are very straightforward. We see the earnings growth there is the strongest in the region. The rupee is stable. The government is pro-business. The growth rate of the economy is rising from probably 7.5% to 8.5%, maybe 9%, if they pass their VAT or goods and services tax this summer or before the end of the year. That will have a big boost their economy. And really, we just find great companies in India selling at 1 times their growth rate or less. And, we find good companies in Korea, in Australia, in Indonesia, but the growth rate in India is double that of the other countries. And I think I would argue that looking out the next 2 or 3 years, we see that India is a protected environment when it comes to these external political shocks. They were not affected by Brexit. They will not be affected by Trump if he's protectionist. And they will not be much affected by a slowdown in the Chinese economy, which in most of the other Asian economies will feel quite rapidly. So I think we looked very hard at the trade numbers, and we see that India is principally a domestic play on their huge domestic consumer economy, 1.3 billion people, of whom half are under 25, and many of whom are for the first time getting their first bank accounts and getting connected on internet and mobile phone. So it's a really big change in India.
Going to Japan, I know that you are able to find some very special companies there that are actually benefiting from the burgeoning middle-class Chinese population.
Right. Well, we've invested in a number of cosmetics and healthcare companies that are selling principally to Chinese tourists. And in fact, Japan has been a favorite destination for Chinese tourists, and Korea as well has also benefited. But there is, I think, something of a break. If the yen persists in being so strong, that will hold back Mr. Abe's plan to reinvigorate the Japanese economy. So I think we'll see that he's postponed the tax increases. He's trying to change the constitution so they can increase defense spending. That would also be stimulating. And he's pushing forward social policies, I think, which would try and counter their demographic challenge. So I think that they will try anything, really, in monetary and fiscal terms to get their economy moving again. And I think Japan is an interesting market to be monitoring at the moment.
Now, when I was in Shanghai recently, I heard a lot about the South China Sea claims, and I wonder if you could finish off with a comment about that.
Well, I mean, I think we weren't surprised that the International Court in The Hague ruled in favor of the Philippines, that indeed China's occupation of these coral atolls in the South China Sea, which the British sailors called the Spratlys and the Parasols, was in fact illegal. And they're only 50 miles off the Philippine coast in some cases. Vietnam, Indonesia, Brunei, and the Philippines all have counterclaims on these islands, which, or not even islands, they're not even above water at high tide, which the Chinese are now occupying and building airstrips on. So I think it's a setback for China. How will they react? I don't know. There is some talk of a compromise with the Philippines, joint development of undersea oil and gas resources, which, by the way, they haven't found any oil and gas yet, but there clearly is a value in occupying these very important sea lanes. About a third of the world's trade goes through these narrow sea lanes that come around the bottom past Singapore and then up past the Vietnam coast into China, Japan, and Korea. So they're very important sea lanes which have been patrolled and policed by basically the U.S. Navy for decades, and now China is determined to stake their claim. I hope and believe that we will be able to defuse this situation peacefully. I don't think anybody wants conflict, but it is a concern, and I think it probably weighs on investors' minds.
Well, Robert, as always, that was a great update, and we'll talk again this coming month, and I hope you are enjoying a fun summer.
Thank you very much, John. It was good to talk to you.
We'll go to a break now, and when we come back, my talk with my old friend Dean LeBaron, who's the founder of Battery March Financial Management. You are listening to 580 CFRA.
You're listening to Money Talk on News Talk 580 CFRA.
Well, it's great to be joined by Dean LeBaron, a venture capitalist who is at Lake Sunapee in New Hampshire. And, of course, Dean is the founder of Battery March Financial Management. How are you today, Dean?
I'm very fine, John, and you can also include among my CVs that I'm a longtime friend and admirer of John Budden of Canada.
Thank you. Well, it's a mutual admiration society, so we're dangerous together. I guess I'll start with one of my favorite subjects, and that is the gold market. And gold, of course, has been a commodity for the past 4 years, veering away from its traditional role. And here we are, it's acting like a currency in the past year. What are your thoughts?
Well, John, this is the time to be a gold bug. You've been practicing that way for a while, but it's now for real. I will reveal that one of your side styles is that you perform Nikolai Kondratiev very well on stage. Nikolai Kondratiev is a Russian economist who would have been a gold bug if he had known about it at the time, but he didn't. Now, gold is turning from being a commodity to being money, and the best form of money there is. So we're going to see gold behave quite differently from other commodities and even its historic commodity past. Good timing on your part.
Well, thank you. Now, the anchor commodity in so many portfolios is real estate, and we've seen real estate funds in London close their gates in the past couple of weeks post-Brexit. And there is a market that is wonderful if there's good liquidity, but the character of the market has changed.
Well, substantially so. And let me back up slightly. Real estate is really two things combined. One is easy adoption of leverage, because most real estate is operated on a tiny equity piece and large leverage, so that's what in part is going on. And in many cases, it's invested in by way of a mutual fund or piece of paper or the equivalent of an exchange-traded fund, which separates the ownership away from the property. And that is a different thing. Can I probably impose one element here I think your listeners would like to talk about, and that is the coming difference between a monetary instrument, such as an ownership through mutual funds or an exchange-traded fund, to an actual ownership of the ultimate property. We've gotten pretty far away in many chains from the ownership of the property, which is substantive. It may not have liquidity, but it is substantive. You can hold it, touch it, feel it, and it's yours. The ownership of such property by way of a mutual fund or a partnership may well be fairly distant, and you do not control it. And you may think you own it, but in fact you don't. And that's what people are finding out in London today, that real estate ownership isn't necessarily the real estate itself, but it's a piece of paper which says they own it, but maybe so, maybe not so.
So if there's 7% cash in the fund, not everyone can cash in their chips at the same time.
Only the way you can get your money out of the real estate fund in London and even in a mutual fund in the United States is if somebody is willing to buy it on the other side. Then you can. Otherwise, cashing in is a painful and usually expensive alternative.
Well, this is all about confidence and liquidity, and someone was mentioning to me, if you think there's been problems in the real estate market in London, just watch what happens to the corporate bond market if there are serious withdrawals and the liquidity dries up.
I believe it is important for your listeners to separate out the monetary conditions of their investment portfolio from the actual substantive ownership positions. They are not the same, and monetary is separate from business conditions is a fact that is going to become very important, I think, in the next 1 to 5 years. It may then straighten out, but we will adopt some new positions. Our financial structures have become very complex, very elaborate, hard to understand, and extremely difficult to unwind. We found that in 2008, 2007, and we're going to find it again, except it'll be worse this time.
Taking a look at the U.S., I hesitate to ask you, but what's your view now of the political situation or the evolving and changing politics?
Yeah, well, let me back up a little bit. I mean, we've had a lot of discussion about Brexit, thinking that that's a British issue and a British problem. It's not. It's not even a European problem. It's a global problem. It is the first canary in the coal mine, so to speak, of a global problem where the institutions that were formed in World War II to perform businesses and trade, largely dollar-related, English-spoken, rule of law on the Western model, passed around the world. Now the world is repudiating that. Britain is only the first indication that the dollar world is over and not to be repeated. It's breaking up in the U.S. through, obviously, the candidacy of two terribly disliked candidates, meaning Secretary Clinton and Mr. Trump, and it'll be breaking up in Europe where nobody wants to be the last country left around. So the institutions of World War II that were dollar-related, English-related, are breaking up. what follows is a subject of considerable discussion, and I think that's a topic for another day.
Now, you have savers on one side, and then on the other side, you have people who are playing with this stimulus money. And in countries like Switzerland, I understand that a 50-year bond yield is now negative. Where does this negative interest rate trend take us? Because it's uncharted waters in the fixed income marketplace.
Well, Switzerland has had negative interest rates in the past, sometimes as long as 15 years. And it may again have a future. Switzerland can be a special case. But negative interest rates do seem to be spreading around the world. It's roughly about 25% of the global markets at the moment. And it is a reflection of aversion to risk. Let me just sort of separate out. We would price securities on the basis of risk and return. Once you go to managed interest rates, as you do with central banks, where they specify what the interest rate is regardless of risk and return, you introduce another variable, a third one, which is new to most of us, and that is liquidity. Can you get your money back when you want it? And what's happening is negative interest rates is that you pay for the privilege of having liquidity. That's a new feature, but I have a hunch it's going to be with us for a while. Now, briefly, when you hold currency, the currency is, in effect, a non-negative interest rate, but using the central bank as a zero-cost holder of your asset, in paper, to be sure, but still an asset. That's a different feature than we've had before.
The stock market is yet another piece of paper. It's pieces of paper representing ostensibly real assets or businesses. And because you get no interest rate in fixed income, people have gravitated to the stock market. And there seems to be a sense of complacency. There's certainly a lot of speculation, and there's a lot of money moving into the stock market because markets are reaching new highs. What's your view on stock markets these days?
Yeah. Money will flow into the stock market because it is believed to have liquidity. This is kind of the discussion that we just had. However, we will find that it can be an illusion. It's only liquidity in the sense that there's a Ponzi scheme that somebody else is willing to be on the other side. In the U.S. and Western markets these days, with algorithmic trading and so forth, almost all the formulae that function, operate market asset allocation systems for institutions are extremely similar. We tend to put people all on one side, which makes us all bullish or all bearish at the same time. That is a very unhealthy situation, and we'll pay for it.
We've been discussing various asset classes and liquidity, and so liquidity is the linchpin of all the games that are being played. And you and I have talked about another aspect, which is the dog bone hole. From the book, The Dog Bone Portfolio, we determined, and actually you coined the phrase, the dog bone portfolio, but that investors have to think of where their assets or their securities are actually located.
As I have encouraged your listeners to watch the neighborhood dog who buries his bones very carefully and tends to diversify the location and does not share the location of any one bone with the other neighborhood dogs. We can learn from the neighborhood dogs when we hold our portfolio, make sure that we're holding them in our name, close to us, and not share the control with others. I don't think we're very aware of this issue at the moment, but they were aware of it in the U.S. Depression in the 30s, and we're becoming aware of it in the city of London now, which is likely to spread. So I think there's a global phenomenon that holds the control of your assets yourself. Make sure that you have whatever liquidity you feel you want, but make sure that you control the assets that you might need at some point.
Now, your career spans many years, and I guess my final question is, what advice would you give young people, because young people are living by different rules, and certainly in the securities game, they're much better equipped to deal with the high-frequency trading, the algorithms, and the pace of innovation in technology and life in general.
Yes. I envy the young people today because they have the opportunity to engage in industries that are disruptive. We are talking about the possibility that the power industry will be completely changed. Transportation, I mean, cars would be completely changed. Any one of these features, obviously energy, can be completely changed. If you have the opportunity to engage in rapidly evolving industries that are disruptive of old standards, education, as they're changing, medicine, and so on. What a wonderful time to get started on some of these fields. I envy them the chance of doing it. I won't do it because of my age, but I will stand by and applaud and encourage when I have a chance.
Well, Dean, as always, this has been fun, eclectic, and we'll have to do it again soon.
Look forward to it, John.
Thanks so much for joining us on Money Talk. Okay, folks, thank you for joining us on Money Talk this afternoon. Have a great week. We'll be back 2 p.m. next Sunday. I'm John Budden, and you are listening to 580 CFRA.